Should you lease a car, buy it with cash, or finance it with a car loan? In 2026, getting this car buying decision wrong can cost you thousands of dollars. The average new car payment is now around $770 a month. And some buyers are stretching their auto loans to 7 years or even longer just to make an expensive car fit inside their monthly budget. But here's the strange part. One car dealership can show you a payment of $500 a month. Another can show you $600, and another can show you $700. And your brain immediately wants to choose the lowest monthly car payment. But that number doesn't tell you what the car actually costs. Because a $500 monthly payment doesn't necessarily mean you're getting a cheaper car. It could simply mean you're taking longer to pay for it, potentially paying more in car loan interest over time. And leasing a car isn't automatically the cheaper option either. Leasing can give you a lower monthly payment, but after 3 years, you may have paid tens of thousands of dollars and still have no car ownership to show for it. Then there's buying a car with cash. No loan, no interest, no monthly payment. Sounds perfect, right? Not necessarily. Because if you put $40,000 into a car today, that money can't simultaneously sit in your savings account or be used for another financial goal. That's where opportunity cost comes into the picture. So today, we're going to follow one person through all 3 car buying options: leasing, financing, and paying cash. We're going to look at the actual car loan mechanics, the numbers, the psychology of monthly payments, the hidden costs, the total cost of ownership, and the mistakes that can turn a perfectly reasonable car purchase into a financial headache. And by the end, you'll know which option makes the most sense for different types of buyers. But more importantly, you'll understand how to decide whether to lease, finance, or buy a car with cash yourself. Meet Alex. Alex needs a car. Not a sports car, not a luxury SUV, not something designed to impress everyone at the traffic light. Just a reliable vehicle for commuting to work, running errands, visiting family, and handling everyday life. Alex walks into a dealership with a rough idea of what he wants, and the salesperson gives him 3 choices. He can lease the car, he can finance the car, or he can buy it outright with cash. At first, all 3 options sound reasonable. The lease has a lower monthly payment. Financing allows Alex to spread the purchase over several years. And paying cash means there is no auto loan at all. So Alex asks the question almost everyone asks: how much is the monthly payment? And this is where the story gets interesting. Because the monthly payment is one of the most powerful numbers in the entire car buying process. Not because it's necessarily the most important number, but because it's the easiest number for your brain to understand. Imagine someone tells you a car costs $50,000. That sounds expensive. Now imagine they say, it's only $699 a month. Suddenly, the car feels more affordable. But nothing about the car actually became cheaper. The price didn't change. The interest didn't disappear. The depreciation didn't disappear. The insurance didn't disappear. The taxes didn't disappear. You simply changed the way the price was presented to you. And that's why the first rule of this entire video is simple. Don't start with the monthly payment. Start with the total cost. Because if you want to understand whether you should lease, buy, or finance a car, you have to follow the money. Let's start with leasing. A lease is essentially a contract that allows you to use a vehicle for a specific period of time. Instead of purchasing the entire vehicle and owning it immediately, you're paying for the use of that vehicle during the lease period. A typical lease might last around 2 or 3 years. And here's why leasing can look so attractive. Suppose the car has a price of $40,000. You aren't necessarily paying $40,000 over the next 3 years. Instead, the lease calculation is influenced by how much the vehicle is expected to be worth at the end of the lease, along with the negotiated price, the lease's finance charge, taxes, fees, and incentives. In simple terms, you're largely paying for the value the vehicle loses while you're using it, plus the financing and other costs built into the contract. Imagine you lease a $40,000 vehicle. If the vehicle is expected to be worth $25,000 at the end of the lease, the depreciation portion you're effectively paying for could be roughly $15,000. Of course, Actual lease calculations are more complicated than this example. But this is the basic idea. And that's one reason leasing can produce a lower monthly payment than financing the same vehicle. There are also some lifestyle benefits. If you like driving a newer vehicle every few years, if you don't want to worry about selling your old car, and if you know you're going to stay within the mileage limits, leasing can be convenient. But there are trade-offs. Most leases come with mileage restrictions. Drive significantly more than the agreed mileage, and you may face additional charges. There can also be charges related to excessive wear and tear. And here's the biggest difference. At the end of the lease, you don't automatically own the car. You generally return it. Or, if the contract gives you a purchase option and you choose to exercise it, you can buy it. So after making lease payments for 3 years, you may have spent $20,000 or more and still need to make another decision about what car to drive next. That's not necessarily bad, but it is important to understand what you're actually paying for, because a lower monthly payment does not automatically mean a lower total cost. Now let's look at financing. When you finance a car, you're buying the vehicle, but you're borrowing money to do it. The lender provides the money. You take the car, and then you repay the lender over time. This sounds straightforward, but there's one word that changes everything: interest. Borrowing money isn't free. Your interest rate determines how much you'll pay on top of the amount you borrowed. And that rate can vary depending on your credit history, the vehicle, the loan term, the lender, and broader market conditions. For example, recent Experian data showed average new vehicle loan rates around the mid-6% range, while used vehicle rates were considerably higher. And that difference matters, because a car loan isn't simply a mechanism for dividing $40,000 into smaller pieces. It's a financial contract. Suppose Alex finances $40,000 with a hypothetical 6-year loan at 6.5%. The monthly payment would be roughly $670 before taxes, fees, and any down payment. That sounds manageable. But over 6 years, Alex would make roughly $48,000 in payments. So the car didn't cost $40,000 anymore. The financing added thousands of dollars in interest. And here's another problem. When you stretch a loan over a longer period, the monthly payment can become smaller, but the total amount of interest can become larger. That's why an 84-month loan can look attractive on a dealership worksheet. The monthly number comes down, but you're committing yourself to payments for 7 years. And that creates another risk. The vehicle is losing value while you're still paying the loan. Imagine you buy a car today. A few years later, the car is worth considerably less than what you originally paid. But your loan balance may still be substantial. If you need to sell or trade the vehicle at that point, you could discover that you owe more than the car is worth. That's called negative equity. And once you're in negative equity, getting out of the vehicle can become much more complicated. So remember, a longer loan doesn't make the car cheaper. It simply spreads the cost across more time. Now we reach the third option, buying the car with cash. On the surface, this sounds like the financial winner. You pay the dealer, you get the car. There's no auto loan. There's no loan interest. There's no monthly car payment. And you own the vehicle. Simple. But there's a hidden concept that many people forget: opportunity cost. Imagine Alex has $40,000 sitting in savings. He could use that $40,000 to buy the car. Or he could keep some of that money available for emergencies and other financial goals. Now, this doesn't mean you should automatically finance a car because you think your investments might earn more than the loan interest. That's a dangerous oversimplification. Investments can go down. Investment returns aren't guaranteed. A car loan creates a contractual monthly obligation. So comparing an uncertain investment return with a guaranteed loan payment isn't an apples-to-apples comparison. The better question is, what happens to my overall financial situation if I pay cash? If Alex buys the car for $40,000 and still has a healthy emergency fund, stable income, and money available for his other financial goals, paying cash may be perfectly reasonable. But if buying the car wipes out nearly all of his savings, that's a completely different situation. Imagine two people. Person A buys a $40,000 car and still has $20,000 in emergency savings. Person B buys the same car and is left with $500 in the bank. They both own the same vehicle, but financially they are in very different positions. That's why the question isn't simply, can I afford the car? It's, can I afford the car and still remain financially resilient? So, which option should Alex choose? The honest answer is, it depends. And that's actually a better answer than saying one option is always superior. Leasing can make sense for someone who likes driving a newer vehicle every few years, doesn't drive excessive mileage, understands the lease terms, and values convenience. Financing can make sense for someone who wants to own the vehicle but doesn't want to pay the entire purchase price upfront, especially if the loan terms are reasonable and the buyer intends to keep the car for a long time. Buying with cash can make sense for someone who has enough savings to purchase the vehicle without damaging their emergency fund or sacrificing more important financial goals. But there's another option that gets almost no attention, and sometimes it's the most powerful option of all. Buy a cheaper car. That's it. You don't always have to find a clever financing strategy. You don't always need to optimize between a lease and a loan. Sometimes the simplest way to improve the financial equation is to reduce the amount of money you're putting into the vehicle. If you're choosing between a $50,000 car and a $25,000 reliable vehicle, the $25,000 vehicle doesn't have to beat the $50,000 vehicle in a financial spreadsheet. You've already saved $25,000 before the calculation even begins. And every dollar you don't borrow is a dollar you don't have to repay with interest. That's why one of the most underrated car buying strategies is borrow less. And this brings us to the bigger lesson. Buying a car isn't just a transportation decision. It's a financial decision. Every extra dollar you commit to a vehicle is a dollar that can't simultaneously go towards something else. It could have gone toward your emergency fund, your retirement account, paying down debt, saving for a home, building an investment portfolio, or simply giving you more financial breathing room. And that's why the best car isn't necessarily the one with the lowest monthly payment. It's not necessarily the one with the lowest interest rate either. And it's definitely not automatically the one with the newest technology or the biggest engine. The best car is the one that fits into your entire financial life. So before you lease, finance, or buy your next vehicle, ask yourself 3 questions. First, how long am I realistically going to keep this car? Second, what is the total cost, not just the monthly payment? And third, what will this decision do to my financial future? If you can answer those 3 questions honestly, you'll already be making a much better decision than someone who simply walks into a dealership and asks, how much can you get my payment down to? Because the goal isn't to find a car payment you can survive. The goal is to find a car you can comfortably afford, while still moving your financial life forward. If you found this breakdown useful, subscribe for more practical personal finance and investing videos that help you make smarter decisions with your money. And before you buy, lease, or finance your next car, remember, don't just look at the payment. Follow the money. If you want to know how car dealerships make millions without relying on car sales, watch my full video, How Car Dealerships Make Money.